Okay, everybody, welcome back to the More Doors podcast. Today is episode 36, and we are here with the one and only Zach Haptonstall from Rise 48 Equity. We'll be back with his interview right after this. All right, everybody, welcome back. Today is a very special episode. We are super excited to have our first $1 billion plus asset manager and multifamily operator, Zach Haptonstall, CEO of Rise 48 Equity. Zach's going to join us from the very lovely, very sunny North Scottsdale, Arizona. But before we jump into the interview, we need to thank our sponsors.
We do.
They are fantastic sponsors. The most amazing sponsors ever. Number one, those great guys at Deep Blue Capital. Go check them out, deepbluere.com.
Love those guys.
They're the best guys ever. Super handsome, fairly intelligent, pretty good senses of humor.
Decent cooks.
I'm not.
Lovely wives. Yeah, we heard about that.
Yeah.
And yeah, so check us out, deepbluere.com. We've got some great news literally on the stove as we speak that we'll be coming out with hopefully before the weekend, and some other stuff that we've been working on behind the scenes. Also, go check out the one and only Jesse, best beard ever, Showalter at torestudios.com, TORE studios.com. If you want to uplift your podcast game, if you want to sit in a fancy studio with neon blue uplighting and
A
lot of depth.
Jesse's always talking about depth.
Amazing decor and depth. Go give Jesse a shout at torestudios.com. Tell him we sent you, and he'll probably answer the phone, which is awesome. Awesome. How we doing, boys?
Boys, I'm doing well. It's fun to be back in the studio. We took a little bit of a week off.
We did.
We let the wives take over.
That's one of the few that I've watched all the way through since we're normally in this seat.
Yeah, we live it.
Yeah, we live it. And, listening to it, the wives, episode 34, the Deep Blue spouse takeover, they crushed it.
They did very, very well.
What I noticed is it was very much a case study in how people express love. Like, my wife was way too kind about me, and Nick and Heather express love completely differently. Heather low key bags on Nick all the time, and it's hysterical.
But listen, according to Heather, you like the dog.
I do not like this dog.
Bro.
That is not
She
true.
said you love the dog.
I heard that is false news.
You get caught petting it when you think.
What am I? I'm not going to kick a dog.
You don't have to kick it. You just don't have to pet it.
Yeah, act ambivalent. But
it's right there. Like, I'm not going to treat an animal mean, but that is not my dog.
Dude, dogs can tell when you don't like them. You need to love on
this dog. Knows because it's trying to love on me and it's trying to butter me up.
He's trying to win you over, bro.
Yeah, it's not working.
Yeah, that's not what Heather says.
That's a
Do
lie.
you want us to play it for you?
Sure.
We have it on video.
Absolutely. Let's bring Zach on. Enough about me and this darn dog. Zach, well, welcome to the show. You need to go back and watch episode 34, Zach, and you'll find my wife brought home a dog the 2 days before Christmas that was not discussed. And I would much rather her bought an apartment complex without telling me than bringing home a dog. But with Rise 48 Equity, give us your version of who you are, the 60-second view, and let's dive into this.
Let's go.
Yeah, no, awesome. Thanks so much, guys, for having me. Really appreciate it. I just want to really thank Deep Blue Capital. Now, those guys are great for sponsoring this podcast. So
appreciate it, brother.
Good looking out. Yeah. No, but thanks so much, guys. Really appreciate it. So yeah, I'm Zach Haptonstall, the CEO and co-founder of Rise 48 Equity. So we are a multifamily operator, just focused on value add deals. We're looking for B class assets in A and B locations. So we're based. Our headquarters is here in Phoenix, Scottsdale area, Arizona. And then we expanded to Dallas, Fort Worth, end of 2022. So we're focused on those two markets exclusively. We've purchased now 49 different properties, a little over, 2 billion of transactions, about 9,000 units. And it's all just been value add multifamily. So we have our own property management company, a construction company. We have a little over 240 full-time W-2 employees on full benefits. And we're just kind of laser focused on this one thing. So we've been fortunate to, kind of scale, and looking forward to expand to other markets here in the future too. So that's a little bit about our background, and happy to be here.
Nice. Did you say 9,000 units, Zach?
Yep.
Okay. So, I mean, that is an amazing number. Congratulations. Like, what is it, aside from a lot of work and a lot of underwriting, like, what does it take to build a 9,000 unit portfolio and ultimately grow into, a vertically integrated powerhouse?
Yeah, no, thanks, man. I mean, it's crazy, man, because we bought our first deal February of 2019. So it was about 5 years ago.
Wow.
But it feels like it's been like 15 years. Like so much has changed, and we're always going full speed, and always trying to adapt. But I think, some people are like, well, how did you guys scale like that? And for us, I think the biggest factor, to be honest with you, is the fact that the first 40 deals we bought were all in Phoenix. We stayed super concentrated, laser focused. Because in real estate, it's easy. You guys know you can make money in so many ways. You can go to development, mobile home parks, self-storage, whatever. And we tried to just stay disciplined, even though there were those temptations to just keep rinse and repeating. And so we started to get into a rhythm where you're doing the same thing over and over. And we could get to any of these properties within 30 to 40 minutes of each other. We have the exact same supply chain, the exact same labor. All of our costs are fixed. We brought the management in-house a few years ago. So it just starts to become rinse and repeat. And you use the same lenders. Your investors know what to expect. You have a lot of repeat investors. You can execute the plan and remove a lot of the variability of risks and even cost variability. And so I think that was the biggest thing, is to just kind of rinse and repeat, almost create like an assembly line, to crank out these renovations. And then we expanded to Dallas, and we had the same supply chain, our same supplier there. And that was a good experience for us to learn how to kind of open up a new office, hire local staff. So we've got a little over 50 full-time employees in Dallas. We own a little bit over 2,000 units there. And then we have, our Phoenix portfolio. So I think it's really just kind of staying laser focused. And then you hit this point where you start to see exponential growth. So to get you guys an idea, January 2018, I quit my job and sold my equity in this company, the healthcare company. And I had no plan what I wanted to do. I just knew that I hated that. I didn't want to do that anymore. I was miserable. And my plan was to live off of savings and kind of figure out how to get into multifamily. So it took 14 months to actually close the first deal, which is like a 36 unit, $3.5 million deal. And it was just me and a handful of people that put our own money in there. We did not have any passive investors. Okay. Wow. So we had to execute the plan. Then we started to syndicate. But I can tell you after 3 years, so 36 months, we had bought 6 deals, like 65 million. And then in 2021, so 2018, 2019, 2020, I had made no money. I was in $12,000 of credit card debt because I put all my money in the deals. People are like, oh, you own $60 million worth of real estate. Well, I was broke because all my money was in the deals, and the preferred return eats up all the cash flow. I had to go back and get a job. So I went back to get a job in healthcare, and we were running the real estate company at night. And my partner, Bikram, was working this entire time. Well, then at the end of 2020, so really we had bought the first deal about almost 2 years prior, but I was grinding for like 3 years, just laser focused on this. Everything started to click at the end of 2020, early 21, where we started to sell our first deals. So now we were getting flushed with liquidity because I'm getting my money back, getting a good return on it. We started to get a ton of investor referrals because we started to sell those first few deals. And so you're going full cycle, and investors are happy. So they start to refer you all their colleagues, friends, and family. So now we have personal liquidity. We have a growing investor base. The first 4 deals we bought were completely on the market through the brokers. And so one of the answers to your questions, Matt, is that, we were able to source most of these deals off market. Okay. Mm-hmm. So broker relationships are key, right? And then obviously you have to raise the equity and you have to operate. There's all these components to it. But we had proven our track record to execute. And so we started getting off-market deal flow at that same time. And then for new deals, we started to take acquisition fees. We never took acquisition fees prior because we want to kind of prove the concept. Mm-hmm. And so now we were generating revenue. So we converted to an S Corp end of 2020 so that the 3 of us who started the company could start to take salaries. Yeah. Right. And so then in February of 21, I quit the job the second time, and we got an office in March of 21. We hired our first employee in March. And so 2018, 2019, 2020, we bought like 6 deals, like 65 million. In 2021 alone, we bought 16 deals, 560 million.
Wow.
In 2022, we bought another 16 deals, 860 million. Right. And then 2023, even though there was a ton of, it was tough with interest rates and, there's not as much investor demand. We still bought 10 deals last year, 340 million. So the first 3 years, it's kind of like, you guys have heard that cliche analogy, like a rocket ship uses all this fuel and energy to get off the ground. But once it hits a certain point, it's just kind of, it's like effortless, right? So I'm not saying it's effortless, but we saw this inflection point where the first 3 years you have nothing to show for it and I'm dead broke. But then you start to click and you start to say, okay, now we know what we're doing. Now we have more track record, and then you can just compound and exponentially grow. So I think that's kind of what, we've experienced, and we've been fortunate. We were fortunate to be in a good market, right? That makes us look smart and kind of, pours jet fuel on some of those returns. But we also made sure that we invested all those profits back into the company to build infrastructure, So we basically hired our first employee literally 36 months ago this month. And now we've got almost 250 people. And so we've built out all these different departments. And I think in the beginning, and my last point, and then I'll stop talking, you ask the next question, is that in the beginning, the long-winded answer, I know. In the beginning, we were doing every little minutia detail, okay? Sourcing the deals with the brokers. I was handling all the transactions, like doing loan docs with lenders counsel, our counsel, all that stuff. Asset management, marketing, investor relations, distributions, monthly reporting. So we knew all the minutia details. And my wife works in the business full time, and so does Bikram, my partner's wife. And so we almost had like 2 free employees, like bonus people, right? Free labor. So we had like a bigger team. And when we learned how to do all these things, once we started to generate revenue, we were able to hire people and train them to do that and build out departments and really delegate and build the company the way we wanted to build it. And that allowed us to kind of focus on our highest and best use, right? To focus on growth and still oversee the operations and all that. So anyways, that's kind of how we got to where we are now.
That's amazing. So I have to ask a very selfish question. So I tend to geek out on underwriting and spreadsheets and models and all kinds of stuff. You guys bought an enormous amount of deals over the last couple of years, which means you probably saw way more than that number of deals and weeded a bunch out and bought the ones that fit your buy box. So can you walk us through kind of your deal review, underwriting, acquisitions process? How did you evolve that, and what does it look like today?
Yeah, no, it's a great question, Matt, because this is one of the big reasons why people can't scale or they get sort of discouraged. Because when I first started, I underwrite 30 to 40 deals. Like, none of these pencil, none of them work. Am I doing something wrong, or is the market overheated? You just get so discouraged and you just want to give up because you're like, what's the point? Like, I'm so far off. I feel like an idiot even telling this broker where I'm getting, right? Because I feel like something's wrong with me, or these other guys are just idiots who are paying for these deals. And so my background, is not like, I have an MBA. I've taken some accounting classes. I am not a numbers guy. Okay. I freaking hate sitting in front of Excel spreadsheets. I'm not good at it. So when I met my partner, Bikram, he is the perfect complement. And I was seeking out his skill set. I kind of knew what my weakness was, which was the underwriting financial analysis. So Bikram, economics degree, CPA, he worked at one of the big 4 accounting firms as a corporate auditor for a number of years. So he loves sitting in front of Excel. He's extremely fast and efficient, and he's built out his own model, which is very, sophisticated. And so to answer your question, my focus is to source deals. Okay. So as you guys know, in every big market, like Phoenix, Dallas, other markets, there's like literally 5 or 6 brokers, like 5 or 6 individuals who control 90% of the inventory. Mm-hmm. And if you don't get in with those guys, good luck. You're not going to scale. Like, you have to play the politics and you have to build these relationships, and you can't retrade. You can't drop out of a deal because then they blacklist you. Right. And it's pretty cutthroat. And so you have to build those relationships. So in the beginning, it was intimidating. I'm 32 now, but when we started, I was like 26, 27. I'm calling these brokers and I'm like shaking. I'm so nervous because I feel like I don't belong, and but I don't want to look weak. So I'm trying to like fake it till I make it, act like I can close these deals. I'm like terrified. Some of these brokers that I don't want to I got to make sure I close the deal, because you're just worried about your reputation getting ruined before you even get going. And so fortunately, the first 10 to 15 deals, we've just bootstrapped. Like, you don't know where that money's going to come from. You're just grinding it out, trying to find a way. And even still, we launch a deal, there's a ton of anxiety. I launch an email and pray to God somebody clicks a button. Yeah. You have no control over it, right? It's always stressful. I tell people I live in like a constant state of anxiety and pressure because we're always raising money. And it's like, you're going to lose $500K, $1 million if you don't raise that money. And fortunately, we've always closed, knock on wood. But getting back to the point is, you got to build the broker relationships is the first thing. And you have to crank the volume. Okay. And so To give you an idea, it's like a 2 to 3% hit rate for deals that we underwrite. So as an example, last year was our first year in DFW. We underwrote over 250 deals and 8 of them penciled. Okay, like 2 to 3% hit rate. And we were the number 1 buyer in DFW in the country last year. We bought over 2,000 units. And obviously it was a slow year. So in a normal year, we probably wouldn't have been. But the biggest advantage for us entering a new market was that we had been one of the biggest buyers in Phoenix the last 4 or 5 years. Like we were number 1 in 2022. We were actually, it was us as number 1, Blackstone was second. So we have, like, I can basically call any top broker in Phoenix. They'll take my call and they'll send, we do see deals first, you know, or we're one of like 3 or 4 groups that see them first. And so because we have these relationships and we've executed and build that track record. So, but it takes time to get that, right? So initially you have to be you need to meet all the brokers. You have to underwrite everything, and you have to be touring, and you have to play the game. Okay. So my background was in healthcare marketing. And so it's like a psychology thing. These brokers think they're selling me. I'm the one selling them. Okay. I will tour deals that we have no intention of buying just to get in front of the broker, or just because I haven't seen him in a couple months. I'll be like, hey, can I tour that deal with you? And I'll just go out there and just, hey, how you doing, man? Like, let's just, just get in front of him, just be on top of his mind. We'll underwrite the deal. We'll give him feedback, and then we'll tell him, hey, we can't get there. We're going to pass on this. But the point is you stay on top of their mind. So I'm marketing to them. Okay. So we built that track record up. So we're getting a lot of deal flow, but when you're starting, you just got to crank the volume. And the reality is I think people get discouraged. And I know this happened to me. When you're starting out, you feel like it's a big, intimidating industry. These are big buildings, big dollar amounts, and you don't want to look weak, or you don't want to look like I'm 5 million off of the guidance, the pricing guidance that you're telling me. Like, am I doing something wrong? You can't think like that. You need to just constantly give them prompt feedback, because most people are not getting to those prices. But when the broker sends you a deal and they don't hear back from you, they don't take you seriously. If you underwrite the deal, you tour it, and you give them thorough feedback, this is why, this is my assumptions, things like that, they at least know that you spent time and you worked on it, and they respect that. And they want to keep giving you deals. They want to keep sending them your way. Okay. And so that was the biggest thing, is just, initially you just got to crank the tours, crank the underwriting, crank the LOIs. I tell people, if you like a deal and you're 5 million off, send the LOI. It does not hurt you to send the LOI. Because when I started, I was like, I'm not going to send an offer. He's going to think I'm stupid. Send the LOI, because now he's actually going to take you seriously. You're going to catch his attention. Yep. Because these brokers need to show their sellers are getting traction. Even if the price is low, getting an LOI is a win for that broker, because he's at least showed his seller he's getting something, right? And even if the price isn't there, and the broker can say that's the market to the seller. So you gotta maintain these relationships. Once we started getting going and we had that momentum, and I had these relationships, when we were going to go to Dallas, I called all the top Phoenix guys. I said, hey, we're going to Dallas. Can you please introduce me to your top guy in Dallas? And as you guys know, it's all the same firms. It's CBRE, Mark Similichap, Northmark, Berkadia, JLL. There's like 5 to 7 firms that control every market. So they basically do email intros and endorse me and us to all these local brokers. I set up in-person meetings with every single broker in Dallas, go there for a week, bang out the meetings. This is our track record. We sign a loan. We raise the money in-house. We've never dropped a deal. I'm always going to give the deal back to you. So like, you got to remember that these brokers, a lot of these guys have been doing it for 20, 25 years, and they might have sold the same deal 5 times the last 20 years. If you break their chain, you get blacklisted. So any deal that you get, you buy a deal from a broker, marketed or off market, you have to always give it back to them when you go to sell it. Yep. Otherwise, they will not work with you again. And so that's what I tell these guys. I said, hey, we've gone full cycle, sold 11 deals. We've given it back to the broker every single time. And so we were immediately, no BS, within a week of entering Dallas, we were getting all this off-market deal flow, okay? And because we had the track record and we were endorsed. And as an example, I know at the time that we're recording this, we're in the first week of March. I don't know when you guys will post it, but we are actually, this is actually not even, nobody knows this yet. We are expanding to Charlotte, North Carolina. So next week, I'm going to be in Charlotte all week. And last week, I sent email intros to all the guys I know in Phoenix and Dallas. And I said, hey, we're going to Charlotte. I'm going to open up an office. Can you please introduce me to your top guy? And so I go on CoStar and I look at who are the top brokers in Charlotte. Because sometimes it depends on the market, right, for the volume. Yep. So like in Charlotte, CoStar is showing me that Cushman & Wakefield is the top group. In Phoenix, Cushman & Wakefield is not a big player. Same in Dallas. In our space, they're not a big player, but I do know some guys. So you got to focus on the little brokers too, because they might be a big firm in another market. And so Newmark is a big group. I have good relationships with the Newmark guys in both markets. Northmark, I know the national president of sales. He's a friend of mine here in Phoenix. And so I emailed these guys, say, hey, we're going to Charlotte. Can you shoot me your guys? They email back, hey, this is Zach. Rise 48's a great buyer. The Northmark president, he literally sent this email this week. He's like, hey, this is Zach. Sell them everything you have. They're the best buyer, blah, blah, blah. And so now I'm going to go meet with all these guys next week, get that deal flow. So anyways, that was a long-winded answer. Brokers are so important, right? Next step is you got to have, some type of underwriting. So when we're getting started, you don't have staff like we do now. You got to have a guy like Bikron who can crank through underwriting. He can get through it quickly, efficiently, and just get that volume and be sending those offers. Now we've kind of built out our process where we have 4 analysts who sit at the office every day. We don't have any remote workers. We don't allow it. Okay, we think it's BS. Wow. So we have a culture where you have to be at the office 9 to 5 every day, or you're at the property for all of our employees. So we don't allow remote work. So we got 4 analysts here, and what they do is they underwrite deals on the front end. They do lender draws, lender reporting, investor reporting. But I will manage these broker relationships initially because I want the broker to know that I am the decision maker, and I basically am the investment committee for our firm. And so when I make an offer to you, we're serious. Okay, we're going to execute, and then they'll send over numbers. Our analyst will plug it into the model, and then it will go to Brady, our acquisitions manager. He'll review it, and if we can get close, then it goes to Bikron, and then Bikron, our CFO and co-founder, Bikron and I run the company. He will dig in and see if he can get close, make it work. If it's close, then Bikron and I will look at it. Like 97, 98% of the time, I'm not even meeting with Bikron on these deals. Like the brokers are sending me the deals, and I'm constantly bombarding these guys. Like I literally every week I call these guys. I'm like, hey, I need a deal. Can you send me this? Like I'm marketing to them, and so they're sending more deals, and I'll give them crap like, hey, did you forget about me? And you just constantly stay on them. So we're getting deal flow in because I know it's volume, right? And I'm trying to build out a pipeline. And then the way that we do it is that we're very methodical. We'll launch a deal. We give people 2 weeks to sign and fund. Then we close it 2 weeks later. And so I want to make sure I have typically at least 3 to 4 weeks in between my launches to investors. So as an example, we could not find a deal from September of 23 through early January of 24 here. We were underwriting like crazy. Nothing was making sense. And I was just bombarding the brokers, touring deals. And then literally within 1 week in January, we got 3 different off-market deals from 3 different brokers, and they all penciled. So we tied all of them up in 1 week. But we basically built out extensions into our escrows so that I can close these things, 3 months out. And so we'll build out a pipeline. So like right now, I talked to a broker this morning. We're closing a deal today in Fort Worth. And the guy just called me right before this recording. He's like, hey, congrats, man. Great working with you. I said, hey, yeah, great working with you. I said, I need a June closing now. And so if I can tie up a deal in the next 2 or 3 weeks, I'll do a 90-day escrow and I'll close in June. And so I'm just honest with them. I say, hey, I've already got a deal or 2, but this is my timeline. And we build that into the contract. So we're constantly having deal flow, constantly underwriting, constantly giving feedback to the brokers. And like right now, we're kind of busy as an example. We don't have a lot of bandwidth to underwrite because we have a couple deals going. But I just told Bikron the other day, I said, hey, I'm going to Charlotte next week, and I'm going to be pushing these Charlotte brokers. This is our first impression. The first time I'm meeting with these guys, I'm going to meetings, lunches, dinners, and they're going to start sending me deals, and they already have to do that. We got to get them quick feedback and detailed feedback because that first impression is critical, right? So if a deal doesn't work, we got to give them a thorough analysis in an email, and we show our assumptions. We'll screenshot the assumptions. Hey guys, this is why we can't get there. This is what we're using. Let us know what I'm missing here, right? And one other thing I'll mention, okay, this is another, I just thought of this. This is what we always do. We always use the in-house debt team for the investment sales team. Okay, so if CBRE is selling me the deal, I'm always using the CBRE debt broker. If it's JLL, I'm using the JLL guy, because how this works, just so everybody knows, this is common, is that you pay the debt broker. For those of you who aren't familiar, they'll call it capital markets or the debt guy. He's basically going to go out to 50 to 100 lenders. If you're doing like debt fund bridge loans like we do, or he'll go to Freddie Mac, Fannie Mae, and he'll bid out your deal to try to get the best loan terms, right? So typically you're paying this debt broker like a point, like 1% of the origination fee. Well, the way it works is that all these big firms, the investment sales teams are pushed by upper management to try to push their own in-house debt guy for every transaction so that the firm can make more money. They're making money on the commission for the investment sales guy, the sales broker, and for the debt guy. And the debt guy always gives a portion of their commission to the investment sales broker if they're being used. And so what I always tell the brokers, and I've been having calls with these Charlotte guys, and I'm telling them, I will always use your in-house debt guy, no matter what. And that they're incentivized to give me that off-market deal before somebody else because they know they're going to get the debt, right? And so that's another thing. So anyways, that's kind of how our process is for sourcing the deals and maintaining the relationships.
That's amazing.
Yeah.
Everybody go rewind that last 5 or
there's
6
a
minutes and
career's
then,
worth of advice in that.
put a ribbon around it and drop the mic.
Thank you so much for sharing everything, bro. I mean, that is, like I said, that's a career's worth of advice. And you touched on so many different things. I want to kind of circle back to a couple of them. First, just the idea of the hockey stick, that so many entrepreneurs die on the vine before their business hockey sticks. You guys seem to not even have hockey stick. There's a roller coaster in Texas called Mr. Freeze. I don't know if you're familiar with it, but it takes you like straight up in the air like that. One of the things that you mentioned, though, that we talk about in all entrepreneurship is the idea of building the conveyor belt or the assembly line, right? That you build a process. And Nick and I specifically, our background is in residential real estate sales. We both run large residential real estate sales teams. And that's one of the things we see in our industry is, transitioning from selling real estate as an individual to running a very large scale team. It comes with several ceilings along the way where you've got to build out better processes, better systems. And that's where a lot of people kind of stop on their journey. And so recognizing that and then figuring out how to build a better conveyor belt is the way to unlock sort of the next level. And so when you guys were bootstrapping it in the beginning and you've had really rapid growth, how did you know it was time to go, I'm not the best person to do this anymore? And it's time to stop bootstrapping this part of the business. And what was that? And how did you as an entrepreneur recognize it's really time to leverage as opposed to, I just really don't fucking like doing this anymore? How did you make those choices in a really educated manner?
No, it's a great question. Great question, because we're always doing that, by the way. We're always having to evolve. And so, before I got into real estate, I was in hospice, which is healthcare, which I know sounds kind of depressing, but we ran a hospice organization and we scaled a company very quickly and then sold it to a private equity firm. And the whole hospice model, and I have a point, I won't be too long here and I'll apply it to real estate, was that basically the hospice industry is all federally regulated and reimbursed by Medicare insurance.
Okay.
So our goal is to sign up patients. Medicare is billing us, giving us money daily based on how many patients are on our census. And that's how you increase the revenue and the profitability. But for every new patient that you get, every patient needs a nurse, a caregiver, a social worker, medical equipment, staff, all this stuff. And so what I realized quickly was that we had to scale our staff and maintain certain staffing ratios with the scale of our census and how many patients we had. So, we basically grew from like 50 to 110 employees in 18 months and then sold it. And we had a good exit in that private equity firm. But what I realized really quickly is how to recruit, interview, hire, train, and delegate and build out departments, right? And I think in hindsight, that helped me a lot going into this company because I was quickly realizing that you are going to hit a bottleneck where you can't scale because you're getting bogged down with just too much stuff. And by the way, I never had planned to start a property management company or a construction management company. Property management is a pain in the ass. Okay. Oh, yeah. It's a very low profit margin business. It's a crappy business model. First of all, I thought by listening to podcasts and going to conferences, you just buy an apartment building, you slap a third-party management company on there, and you sit back and collect the cash, right? And you can do that. I mean, not to say that's a bad thing, but what we realized literally from our very first deal is that most property management companies will tell you they can do the construction management, meaning that they are running your whole renovation process, right, for value add. So people that aren't familiar, I'm sure your listeners are familiar because you guys do this, but for value add, we're going in there, we're renovating interiors and exteriors to increase the value to sell. And, for those of you who have renovated your house with contractors, they're a pain in the ass. They don't show up on time. They don't finish on time. Everything's more expensive than what they tell you. And so imagine doing like 200 units a month. That's kind of what we were doing last year, 200 to 250 a month. It's a logistics nightmare. So our first few deals, we were using third-party management. We were relying on them to do the construction management. And our very first deal, they were not staying on schedule. They were not staying on budget. So I was literally out at the property, like chewing out vendors, like saying, hey, get to work. Like, what are you guys doing? Because you're not executing the plan. And it was my money. Like, we didn't have passive investors. So we realized quickly our first hire, I think actually maybe it was our second hire, was a construction manager. Okay. Where we basically hired a guy whose job was to source, bid out, and manage vendors. Okay. So like your job is to find the roofer, the electrician, find a third-party construction company, and you're going to walk these units every day, make sure these guys are staying on schedule, on budget. Okay. And then we started to build that out to hiring construction coordinators. So we had multiple guys walking units. We had quality control guys we hired. We hired what we call a supply coordinator who receives the shipment of the materials. So the first thing we did was we had to get construction management in-house. So that's what we did, but we were using third-party property management. Okay. Then we realized, this was like in 2021, like first half of 21, the heels of COVID. If you guys remember, nobody wanted to work. They're all getting these stimulus checks.
We were just talking about this.
Yeah, it's hard. Everybody's lazy. It's hard to find good staff. And what started happening is that we were using a third-party management company, and all these other third-party management companies were poaching each other's staff. And people will leave for like $1 more, right? So like in 5 months, literally, we had 4 different on-site managers of 4 of our assets leave because somebody just showed up, offered them money, they leave. And so I was like, we cannot have this. We need continuity at the on-site level. And I didn't own the management company. And you guys know how it is third-party management. There are good ones out there, but you can complain and complain. Management is thankless. Like these guys are just constantly getting beat up. So they know how to like say sorry, but they don't really care, right? Because they're constantly getting beat up. So I was like, we can't have this. So we started our property management company. At that time, we had 2,000 units. And the second half of 21, this took us like literally 4 or 5 months before we could take the assets over. And we were trying to do it very quietly. So we don't want to piss off our third-party management company.
Sure.
When they found out they were going to get fired. And so we had to get loan approvals from all of our lenders, which was way harder than we thought, because they don't just let you transition these assets to a management company that has no experience. So I had to float money to hire accounting staff. I hired a regional maintenance guy. I hired a president, which I had to fire like 3 months later. She sucked. She was doing her job.
Oh, no.
We had to build out all this staff. And then on one day, I remember it was December 1st, I think, of 21, we basically had like in one fell swoop, we went to, like I sent the email to notify the owner of the management company, hey, we're terminating you guys. We're doing it in-house. And we had like all our team dispersed to all of our sites and immediately give offer letters to the on-site managers to try to retain them.
Yeah.
And like most of them did. But the whole point of us starting the management company was that we had to offer the most competitive compensation and better benefits to recruit and retain the best staff. Because management is such a crappy business model, it's low profit margin, the third-party management company could not afford to pay their staff more money to keep them and be competitive because they need to they have a bottom line, which I understand. For us, we don't need to make money. We just want to break even because it's more about the control. So we cover 100% of all of our employees' medical, dental, vision. We cover 50% of all their dependents. We have a 401k program where we match 3% of everybody's contributions. And we do that across all of our corporate and management employees. So we literally have, as far as we know, like the best benefits in the industry. Like we poach people from Graystar and like Class A management companies, and we pay higher salaries. And the whole idea is to have control and continuity. So that was a big step. And it was by necessity because we realized if we want to keep growing and scaling, then the operations have to stay up to par. I can't just keep buying more deals, not being able to manage it. And that applied to every single department, to answer your question. Okay. So like transactions, I was staying up till 2 a.m. trying to get all this loan docs done. If you got a couple of deals going, it's just ridiculous. So I hired a transactions guy and we trained him, and that was a huge relief. It was worth it, and then he kind of evolved into our acquisitions guy. We hired an investor relations girl who then started to manage our portal and investor communication and reporting. We hired accounting staff, to do distribution. So you just start to train all these people and kind of build it out. And this is still going on, by the way, like just literally last week, I just hired an executive assistant. And I always thought it was like kind of like arrogant to have an assistant. I was like, assistant, like I'll just grind it out myself. I don't want to like be putting my assistant on an email acting like I'm too good for people, but I'm getting so bogged down. I'm staying up to 1 or 2 a.m. literally every night just to catch up my emails. And so I've been training her the last week. Like, hey, these are the ones you can mark as read. I'm copying all these emails I don't need to be on. Delete these ones. I'm training her, like getting her email templates, how to reply to people. So we're just constantly trying to get more efficient and kind of build it out. So it's an evolving thing, but when you start to have a vision and a goal for where you want your company to be, and then you realize, okay, what are my strengths? What are my weaknesses? How do I replace the weaknesses? And how do I free up my time to do, what can, get the company going? Then you have to fill in those gaps. And it's tough because it's like, you need to have revenue, right? To be able to hire staff. So it's like it can be like the chicken and the egg. Mm-hmm. But when you get can get over that point, then you can start to make it work.
Love that, man. That is such great advice. And
Totally.
and I think there's also, the opposite end of that is, I'm sure there are things in your business that, you're probably not going to let go of at any time soon, right? I would imagine broker relations is still probably something that you're very heavily involved in, right? Because there are things that are very core to the business that if you try to leverage those out, like we've seen other people leverage kind of the heart and soul of their business, it collapses almost immediately, right? Is that sort of your experience as well?
100%. No, you said it right, because this is what I told Bikram the other day. I said, I need to be focused, just very simplified. I need to be focused on finding deals and finding money.
Yep.
Okay. So like equity sources and deals. And obviously I do a lot of it. So I sit in on operations meetings, marketing meetings as like oversight. But like, for example, we had an institutional banker here last week because we want to set up an institutional fund. So this guy's an investment banker. He flew here from New York City. We met for like 10 hours. Okay. Like all day. We showed him the properties, lunch, dinner, and we told him about us. And he's like, well, I don't like that you're managing these relationships. How are you going to scale? And I said, you don't understand. Like, my relationship with the broker is the kind of the secret sauce, because they know that, we are the decision maker, and they're not talking to some acquisitions employee who has to get approval from the equity. So I was like showing him the emails literally from the Charlotte brokers where I was getting endorsed. I said, look, these guys just referred me over. This guy just sent me an off-market deal. I haven't even met him yet because his buddy in Dallas said we're a good buyer. So I'm going to go out there, establish a relationship. When they send deals in, I pass it off to our acquisition staff and they do all the dirty work. But I kind of have to be, the representative, the face. I'm the face of the company. And my partner, Bikram, to his credit, he's the one who showed me this, because Bikram is very, unselfish. And, I'm kind of like type A alpha type of mentality, where Bikram, he's an elite worker, but he has a very passive, more submissive personality. And he even told me because at first, you guys have probably seen this, we all had our own personal brands before we became a company, quote unquote, married. Like I was ZH Multifamily, Bikram was Bride Advisors, and Robert was like RNA Real Estate Investment or whatever. At one point, we decided to get married and become an actual company. And Bikram was the one who actually said this. He's like, Zach, we need to become a real firm. He's like, you're the CEO. Okay, you're the face of it. I'm going to be the CFO. And Robert's going to be the chief construction officer. And before that point, when you have your own brands, you don't know. I don't want to be like the egotistical guy that says, hey, I'm going to be the CEO. Right. But we kind of naturally fell into those roles. And so I think that's a big part of it too, is like, okay, what are our skill sets? What is your role? And then within that role, what do you need to be focused on? Right. So now Bikram is really focused on overseeing the accounting teams, high level underwriting, just making sure everything is moving. He's in more operations meetings than I am, because he's managing more staff directly. But I'm focused on like these higher level partnerships now, and I'm trying to get out of some of the weeds, to see what can make us efficient. But it's hard because you don't know. There's no secret sauce. It's like people say, oh, delegate, and then some people say, oh, well, you don't want to lose the grasp of your company, the day to day. And so I think you got to continue to grind it out, no matter what. But you just need to be spending your time on more efficient stuff. And so it's something you're always trying to, kind of learn.
Yeah, 100%.
Yeah.
And I think so much of it, obviously, as you guys have learned, is, like you said, there's no secret sauce, but it certainly helps to have process to find, train, and retain talent, right? And that's something that is an entirely different. I mean, there are organizations that run separate training companies, and just for that explicit purpose. So, what does that process look like for you guys as you've built out different departments? You're learning a lot of this on the fly. How have you found the secret sauce to training and retention to keep your great people?
No, another great question, man. Man, you guys are pros at this.
I should have dressed up today. This would have been like, you don't need it's going to be viral.
The question, I know, seriously. No, because I forgot to mention that. So you're right. I mean, when we started, so here's the thing. This is what I tell people, like, having a real estate syndication company, is you can call it a quote unquote real company if you have a few employees. But my experience was when we started property management, that's when you're running a real company. Yes. Because now I've got all these employees. I've got people fighting. I've got HR stuff to be aware of. When you start to get a lot of entry level employees, you get drama. Okay. So we had to hire an HR director. I went through 3 HR directors in a year because they couldn't figure it out. They weren't doing a good job. It's like,
Did you have the new HR director fire the old HR director?
No, I had to fire the director.
Can you imagine HR getting sent down to HR?
Hi, I'm your new boss. You're fired.
Please step into this HR office. Go ahead and fire her. Yeah. No, yeah, we should have done that. But no, it's like, so HR was like honestly the biggest pain in the ass because we couldn't find the right individual. Now, thankfully, we have two ladies who are really solid. They've been with us for over a year now. So we had to build out an HR team. We had to get, an employee handbook, policies and procedures. You have to get different types of insurance, employment insurance, all this stuff that you don't think about when you just want to buy apartments. You have to become a quote unquote real company and have all this stuff in place. And then it's a great question you asked, because when we started the management company, we did not have a training program. And so in the first 6 months, we had crazy high turnover. Okay. It's because we were hiring these people, we're throwing them on the property. We weren't training them on the property management software. And so people were getting overwhelmed. They didn't feel supported and they blew out. And we're like, well, no shit. Why didn't we think about that? They need support. Right. So we built a training department and we hired a training team. So now everybody who, and honestly, we now own our office building. So like 2 years ago, we bought this office building ourselves. It's like a 21,000 square foot building. The three of us bought it because we knew we needed to grow into something and have space. And so we have this big room downstairs, which is our training and event room. And so all new hires, go through a full week of orientation. We've got like the videos they have to watch, all the HR stuff. And then they're getting on-site training. They're getting training at the office, going through the platform. Then they're getting on-site training. How do you lease? We teach them sales training, how to. All these things are very important for retention and help people feel supported. And then most people don't realize for property management, the national turnover margin in the industry is 40% annually.
Wow.
Okay. So you're going to remember these are entry-level employees and they will leave for $1 more at a lot of places. And so ours is lower than that. I don't know what exactly is, but we've gotten it down significantly over the last year. And so what we had to do was we're like, we need to hire a full-time recruiting supervisor. So we have Asha is our full-time recruiting supervisor. So this is her sole focus is she is constantly putting out ads on Indeed and LinkedIn. Mm-hmm. And even for roles that we don't have open, she's always keeping like on-site manager positions, maintenance, because you're going to have natural turnover. When you've got, yeah, exactly. We have 38 assets right now. And so you've got minimum 3 to 6 staff on every property, so you're going to have people move out of state, whatever, they get a new job. You got to constantly have a pipeline of resumes. So basically we have a full-time recruiting department, which is Asha. We have the HR department, we have the training department, and that's been really, really critical, for retention and making sure that when these people go on site, and it's not just for property management, we have our corporate staff as well. Right. But we had to have some of our people that were here for like 3 years now, we had to have them build out. We asked them to build like standard operating procedures and manuals to train people, right? So that when new hires are coming in, like we even had a guy who was here for over a year. He had to move back to Canada, but he gave us like a 2-month notice before he had to go back. He was like, hey, before you leave, you need to create a standard operating procedure for your role so that I can hire your replacement. And to his credit, he did a good job. And so when somebody else comes in, they can learn all the things you have to do. They have to learn, we use all these different things, like, all of our accounting software. We use like Monday.com to manage a lot of stuff internally. And so, yeah, these are all things that you don't really think about. And again, it's like the whole analogy of building the plane while you're flying it, type of deal. Yep. That's what you're doing when you're scaling a company, because challenges constantly come up and it's like, okay, how am I going to adapt to this? What resources am I going to invest to build this out and make it better? But you do get to a point where you have this infrastructure. I feel like we have this framework now where it's easier to scale because I can just hire more bodies to keep in line with the ratios of what I need, yes, for more apartments, things like that. And so, and then you start to look at like, a couple of years ago, we're like, we hired all these people, our overhead goes up. How can we get more efficient? Right. So you transition to a different property management software and some of this stuff is now done for you. So then you can get a little bit leaner in some areas too. So it's like you're constantly looking at what do I need and then how can I, be efficient.
Yeah, I love that. So much goodness there. So much goodness. Zach, I want to be, we're coming up on time here. I want to be considerate of your time, but I'm very curious about how someone or a company like Rise 48 has really kind of risen to the occasion or adapted to the challenges that we've seen in the business over the course of the last 18 months, right? You have all this incoming new supply. You have inflation, people are getting crushed with property taxes and insurance, and then people are dropping out of the occupancy pool. You get, an increase in delinquency, so on and so forth. So how have you dealt with all that mud in your business over the last, year and a half or so?
No, it's a great question, Matt. I mean, I'll be honest with you. The last 12 months have been like the hardest time of my life. There's been the most stressful, the most adversity by far ever, the most pressure personally, and professionally. And it's because, like you said, so March of 22, the Fed starts the most aggressive interest rate hike in like over 40 years. They do 11 consecutive hikes. And then you have the COVID money kind of dries up last year, right? All the stimulus money. Inflation catches up to people. So their average daily living costs are much higher. And then I think it was like, according to RealPage, I saw that in 2023, there was more new supply of apartments hit the market across the country than any year since 1985. So you have all this new supply that's hitting, which softens the markets. And we especially saw it in Phoenix. And so, I mean, to give you guys an idea and the listeners, we have done a variety of different loan products. We've done 10-year Freddie fixed, we've done 10-year Freddie floating, and we've done a lot of debt fund bridge loans. And we've purchased, operated, and sold all types of those loan products. So we know the pros and the cons of the different products. And so, the last couple of years, the majority of what we've done is floating rate bridge debt because it gives us very flexible prepay penalties so that we can maximize returns. Whereas before, that fixed rate debt is just nasty prepay penalties. The bridge debt also it finances our CapEx dollars. And so we've been doing a lot of that debt. Well, in 2021, we've always bought 3-year interest rate caps, which has been good for us. So I'll say to this point, as you guys know, across the country, capital calls have become very common, right? There's been a lot of distress in multifamily and real estate in general. Like capital calls are happening everywhere across the country. There's groups being foreclosed on now. We're happy to say that we have never done a capital call, never missed a debt payment. We don't plan on doing any capital calls this year, next year, and we're in good shape. But it's because we had to like bust our ass the last 18 months to like really crank things and adjust to what happened. So second half of 21, we were buying 3-year caps, but we were buying caps where our max rate was like 5.5% to 6.5%. And I was buying deals at the time with low 3% interest rates. And to Bikron's credit, he was underwriting 200 basis points of interest rate expansion in the first 2 years. We were assuming rates would go up by 2% in the model. And that was much more conservative than like Chatham Financial and all these forward-looking interest rate curves, right? Which in hindsight proved to be completely worthless. Yep. So, we bought deals second half of 21, early 2022. And literally within a matter of months after buying the deals, my rate goes from low 3s up to 6%. And my debt service doubles. And all of those deals go into negative cash flow. Okay, so we're like, oh shit, we need to adjust here. And we got to crank up renovations in order to force appreciation, push NOI, and get these deals back. And so Q3 of 22, I told our operations team, I was like, you need to beef up the staff and get ready because in January, we're going all out to renovate. Okay. And at the time in 22, a lot of these deals we were buying, we were renovating like 20 to 50% of the units and then hitting the brakes early and stopping so that we could sell it early at a lower cap rate and leave, meat on the bone for the next guy, prove out the concept. And so we were kind of behind on the 2021 deals because we had already stopped intentionally positioning them to sell, because we've sold 11 deals. So we knew how to kind of season the deal and really maximize the return on the exit. So I told him, I said, hey, in 23, we got to crank this up and we got to catch up. And so we hired a ton of staff on construction. One thing I didn't really mention in the whole process is that a few years ago, we basically took full control of our supply chain. So we buy all of our materials directly wholesale from an overseas manufacturer. And so we get fixed pricing on everything. And we do a high level interior scope. So we do quartz countertops, stainless steel appliances, brand new cabinets, everything. It's like a class A interior finish and we get fixed pricing on everything. And we have a lot of bandwidth with that. And so that was also kind of our saving grace last year. And so, we went from renovating 50 units a month to like 200 to 250 units a month. We renovated, in 2020, we renovated 1,923 units. Okay. And to give you an idea, due to all the new supply, Phoenix was like top 5 market in the country for new supply. So there was a lot of softening happening because of all these new apartments. The organic rent growth in Phoenix in 2023 was negative 4%. Rents were going backwards. Okay. Yeah. We renovated almost 2,000 units. Our average rental increase was $453 a unit, which was $20 above our initial pro forma. even net of organic rent growth. And to be honest, we were not assuming negative organic rent growth when we bought those deals. So we were able to basically just crank renovations, force appreciation, push NOI. And we've gotten the majority of those deals back to positive cash flow now, and are in good shape, which is why we haven't had to do, any capital calls. And so, that's been a huge thing. And we're grateful we started the management company when we did, because I know a lot of groups, I have friends that are using third-party management and they're just getting crushed because they don't have control over the operations. Delinquency has trended up. The average occupancy in Phoenix across the entire market, according to CoStar, is like 89% right now.
Mm-hmm.
Our occupancy across our 5,600 units is 96%. And so basically we had to force, this was tough because in Q1 through Q3, we had to force vacancy in order to be able to renovate at a faster pace. At the same time, you have all this new supply hitting, and then people can't afford rents. And so just concessions are happening left and right. So like all of our competitors are giving a month free. So it's like we're having to give these upfront concessions to get people to sign this lease and then burn it off, 3 months into this higher lease. And so we cranked renovations. We brought our average occupancy down to 86% in the summertime because we were cranking. And then in Q4, we eased off renovations and focused on leasing, increasing collections, burning off concessions. And then, now we're at 96% in a good spot. In Dallas has performed a lot better than Phoenix in the last year. Our average occupancy in Dallas, we have over 2,000 units, is 95% right now. We renovated like 253 units in DFW last year. Our average increase was like $50 over pro forma. And so we still think value add is alive and well, but we're being a lot more selective about the submarkets we're looking at. And we're really looking at that. We're looking at obviously demographics because we don't want high delinquency, we want higher median income, but we're also looking at supply because supply has been such a big factor, the last 18 months.
Yeah.
Woo. Lot there.
Tons there.
Really, really.
Yes,
good
we could
stuff.
do a whole show about unpacking what Zach just said.
100%. And we might have to, man. Absolutely.
That was good.
Appreciate everything that you're sharing, man. And like, again, we want to be respectful of your time. This has been such gold and such valuable information. Before we go, I do want to take, one moment to ask a more of a existential question in the sense of, I think of our listeners that are especially on the operations side and actually operating as sponsors and GPs right now.
Yeah.
I think for the last hour, what you've been saying is incredibly energizing, incredibly inspiring. And then GPs go, if I want to build something like that, that sounds like such a crazy lift, right? Building an incredible and scaling an incredible company. How does Zach, the human being, especially the last year of really stressful environment like you've talked about, how does Zach as a human deal with the day-to-day stress, anxiety, just all the stuff that comes with running such a large-scale business?
No, it's a great question, man. It's been tough because it's like you've got so much pressure. I have so much pressure personally, you know what I mean? Because it's obviously like when the market goes south and interest rates shoot up, you have investors reaching out. We have over 4,000 investors, right?
Wow.
And so like I'm doing webinars, like live webinars we sent to all the investors. And then, there was like a media site that wanted to like talk crap about us and make stuff up. So I fought back. I recorded a video and blasted it online. Got like hundreds of thousands of views. So I'm dealing with the media. It really hardens you, honestly, because you feel all this pressure, but you have to rise to the occasion. So for me, the biggest thing is like, I got to stay hydrated. So I drink like 2 gallons of water a day. I stay on my workout schedule. So I pretty much spend the whole weekend like working out, because I basically want to like kill myself on the weekend and push my mental capacity so that during the week I feel like ready to go, and I tell people like, this is like a lifestyle. There's like a lot of sacrifices. Like Becker and I are at this office literally like 9 to 9, 9 to 10 every day, except for Fridays we have like 7. So we're like here 12 to 14 hours a day. And then I'm catching up on emails. And so it's all about, you got to make sure you can get sleep, eat clean, work out, and kind of keep your mind focused and really just block out the noise, because like I never had to deal with the media before. And so this year or last year, it's like I'm having to fight the media, and then people see this stuff and you have to answer to it. Like the media was saying we're distressed. And like, this is total BS. And this is not, I showed them all the data, all the facts. I was like, we're actually one of the few groups that hasn't done a capital call. And so, but then you start to learn that these things pass and it makes you stronger. I told Bikram, I was like, sometimes you meet like these super old guys who are like rich and successful, and they kind of seem like jerks. And I'm like, now I get it, because they do some shit and it like hardens you. You know what I mean? I still think like I'm a nice guy, try to be nice, but it just makes you mentally tough. And it's kind of funny because in the beginning, when I was trying to get going, people tell you can't do it, and they tell you, oh, you're going to fail. They don't take you seriously. So you have to get this mindset of like, well, screw you, F the world, I'm going to do it.
Yep.
Well, then you start to do it and you start to gain success and people will praise you. When you can sustain the success, then you start to get haters. Okay. And you can start to get haters on like LinkedIn and all kinds of people. And then you got to shift back to that. It's like you use that as fuel. So I think it's all about, taking in stress, pressure, criticism, and using it as fuel and motivation. And it's not for everybody. I mean, I tell people, especially at least the last 18 months, you got to have a warrior mindset to get through this, right? You cannot, because I know other CEOs and they're friends of mine, but they have crumbled. They disappear and they're toast. Their companies are going to be done. They're going bankrupt. And so I think it's just like, you got to have that faith. And then it's my faith. Like I'm Christian. I believe Jesus Christ is my Lord and Savior. And I'm praying every single morning. I say, Lord, just give me the confidence and strength to get through this and really to destroy my enemies and destroy my opponents. And you got to use that fuel. And so, but that is the honest truth of like kind of how I've been feeling. But I feel like we're in a good spot and I'm grateful to experience this, because then it gives you that confidence to overcome bigger challenges in the future.
Yeah. Love that, man. Brother, thank you so much for sharing, brother. That was incredibly valuable as well. Man, that was about the most, I think, dense episode we've done.
Without
in
a
long
doubt.
time.
I mean, I think there's so many different black holes that we could go down.
Yeah.
But I mean, Zach, your story is unbelievable, dude. Your energy comes through the internet so very well, man. And I think that probably says a lot about who you are and why you've been so successful, because it takes a huge mindset, and it takes, making people feel a certain kind of way for them to trust you and want to do business and all the things. So I know we're up on time here. I just want to say thanks for finally finding the time for us. And, we had to reschedule this because Zach was doing due diligence on another deal here in Dallas once or twice. And glad we finally got the chance to link up, man. You're an amazing human. Thanks for everything.
No, thank you guys so much for being patient with me and having me on. This was awesome, and really appreciate you guys having me here.
Yeah. Where can people find you online, Zach?
Yeah, thank you. Yeah, I mean, if you guys ever want to, get on a call or I can help with anything, you can find us at, rise48equity.com. So RISE48equity.com. You can actually set up a call with me on my calendar, or you can email me, Zach, Z-A-C-H, at rise40equity.com. I'm happy to get on a call if you're interested in investing, or you're just trying to do this yourself. I'm happy to kind of give advice, because we've gone through a lot of the challenges there.
Yeah, that's really gracious of you, man. I appreciate it. And thank you for the time, man. All right. Episode 36 in the books. Don't forget to check out deepbluere.com, tourstudios.com. Last thoughts.
Let's go.
Yeah.
Episode 36. Thank you, Zach.
Thanks, guys.
See you soon, brother. Thanks, man.